afternoon and welcome to Money Matters TV. I'm your host, Tami Fratis, Managing Director at ACT Capital Advisors, and we have a very exciting show today. My co-host is Skip Massengill of SecureUs, and Skip and I are going to talk about the markets a bit and then introduce you to exciting guests. So Skip, how are you doing today?
All good. All good.
Great. And there's a lot of turmoil going on. How's that impacting your business? But first, tell us a little bit about your business.
Business SecureUs is basically linked to a founding group of 3,100 banks. So we basically maintain an FDIC insurance on clients' assets up to about $250 million per tax ID. And I've been doing that for 22 years. We got about 700 billion on the platform. Now, when everybody's questioning the security of their marketplace, we like that because they're going to go to cash.
Okay, sounds good to me. Now, based on the guests that we're going to be introducing a little bit later, can you tell me about your platform capabilities as relates to high net worth individuals and ultra high net worth individuals, as far as how can they save money either in the form of taxes or you talked about de-risking? But can you tell us a little bit about your individual focus and the platform?
Sure. Individuals with, again, anything over 250,000 that's not an FDIC insured, but most banks, they'll keep those balances. But for a high net worth individual with $1 million or more, corporations, nonprofits, they like the fact that all their money, especially their auditors, like the fact that all their money is FDIC insured. A couple benefits to that, because reality is most banks have a money market account that's not going to pay you very much. In some cases, less than 1%. And then they're going to lend it to me at 7%. That's called spread. That's what banks do. What your job as an investor or a cash manager is to manage it. And what we do is help those institutions and high net worth individuals to do just that, to increase that spread. So at the current rate, we're over 3%. Most banks are less than 1%, and it's daily liquidity. So that helps, maybe not sort of as a tax savings, but it gives you more money to pay the taxes on your other investments that you should be doing other things correctly with.
Wow, that sounds phenomenal. So you did mention the fact that there's a lot more uncertainty going on in the markets today. We have certainly seen with the war tremendous issues in the market. I know in my business, so I'm an M&A buy side and sell side advisor. The war in Iran is impacting my world through the form of margin pressure. So expenses are going up and revenues are getting delayed. And also valuation of companies by buyers is being compressed. But
what kind of percentage of that compression actually, do you see it? Is it already happening?
Yes, it's already happening on valuations. And in fact, just today I had a call where investors wanted to base a valuation on trailing 12 months and not give any concern to the projections or any credit for the projections. And valuation multiples are dropping sometimes by 2%, so 2x, excuse me. So if you're talking about a big deal that had a valuation of 6x, now you might be looking at a valuation of 4x.
And is that because of higher energy costs and tariffs and everything that have been put in place, basically, that people have to live by now?
Yes, it's energy cost impact manufacturing, aviation, logistics. They also impact, when we talk about manufacturing, well, you're spending money to produce chips. Chips go into computers, plastics, right? Energy goes into plastics. So now the plastic's more expensive. Gases are more expensive. So really, the higher energy cost is impacting a lot of industries by increasing operating costs as much as 40%.
Wow. Do you think that the willingness for people to sell is just going to be curtailed, or they're going to step out on their own, or just wait till things level out maybe, or is it just that indecision?
Well, it's interesting you say that. Since we have what's called the silver tsunami, which is baby boomers who own 82% of the companies exceeding the age of 65 and wanting to retire, a lot of them just see the Iran war as a big snooze. It'll go away, things will adjust. And when you see 10 days of the market being up, people think again it'll go away, things will adjust, and prep time to sell takes 6 to 12 months anyway. So they're just proceeding ahead as if nothing's going on, and they should proceed ahead because it takes a while to get ready for a sale. But on the buy side, that's really being impacted because not only has there been an overall decline in deal count and valuations, but fundraising has been basically chopped off at the head. So if you talk about how many funds closed, 84 PE funds closed Q1 this year.
Wow.
$54 billion was raised. Well, don't say wow, because last year it was 406 funds raising $286 billion. That's the lowest level of capital raising since the 2020 pandemic.
Well, I would say cut off. It's not a cut off at the head; it's still cut off at the knees.
The good news is there's still $6 trillion of dry powder out there, but margins are being impacted, valuations are being impacted from a multiple standpoint, and then of course there's earnings compression. But enough about the market. Skip, tell me more about your platform and how you help individuals. I know you help institutions, but specifically, how do you help individuals?
Well, we do a couple things with SecureUs. We also do some tax planning and structures with using and working with their auditors or CPAs. And so if someone's selling a business, we're going to be there to help them and try to matriculate some of that money to cash. But at the same time, what are the most tax efficient ways or programs that they can look at and structure to actually save more of that money that is being compressed? But when they get the sell price, we're going to help them plan out. We do some estate planning with the estate planning attorneys also. So it's really in the high net worth, ultra high net worth family office. We're helping a much broader marketplace than just cash management.
Okay. Wow. That sounds very helpful. So we are going to take a question from our audience. David Young from Philadelphia, my favorite city, asked us, what are the concerns with the private credit area of the U.S. market? Skip?
Cool. I think, all the vicissitudes that we just discussed in the marketplace and the world and everything that's going on, you have a lot of people out there that have put a lot of debt on the street. And they did it in real estate. They did it in deals. They did it in leases. As you said, cap rates are changing dramatically. Prices in some of these real estate investments that were looking good because of the tax benefits down significantly. When you take the private credit piece, and it's based on not vaporware, but basically a promise to pay based on how it's structured. And how it's structured is most important. And so there's a lot of concern out there now. There's not a lot of liquidity. We saw one almost $500 million fund. They cut out anybody's ability to take any of the money out. And they had about a 10% withdrawal per month.
Right.
They just stopped because their concern is it would just cascade into free fall, which then of course hurts the prices. So private equity, if you have it, definitely try to get some evaluations, not from last year, but from current.
Right. Okay. Thank you very much for that. And yes, the credit market, the private credit market is going to see some turbulence, but there is plenty of equity out there. So now if you're interested in sending us a question, here's how to send in your question to Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY-matters, MATTERS, TV.com.
Okay, so we're ready for your questions, but now we're going to invite our guest in. Today we have Lance Morgan, CEO of Legetty International Services. Hi, Lance. Welcome to the show.
Thank you. Nice to be on.
Well, we're going to learn a lot from you, so let's jump in. Lance, before we ask you specific questions, give us the big picture. What exactly does your company do? Who do you work with? And why is the mission so important now?
Great question. So our DBA is College Funding Secrets. So Legetty is the official company, but College Funding Secrets is what we're known by. And we help high-income families to reduce the cost of college through not just the traditional ways, but some unconventional ways, like creating tax strategies and tax savings, for example, for these high-income families that aren't going to qualify for financial aid. We help them to reduce their taxes, particularly with real estate. And we call them scholarship houses. So we show a family how to use a scholarship house to pay for their kids' college and their retirement. And so we set up basically a plan and a partnership with the client where we can help them get into these vacation rentals and take advantage of all the tax benefits that come from getting into vacation rentals for these W-2 employees.
And how did you ever come up with this idea?
Well, it started by having 5 kids. I learned a lot of this out of desperation more than inspiration. But I've got 5 kids, and as my 2 oldest kids got closer to college age, I started to see the cost of college kind of skyrocketing, and realized that it was going to be a lot more expensive than I thought it was going to be. I've been in the financial industry for about 20 years, and I've traditionally taught people how to use 529 accounts and all the traditional ways to pay for college, but it just wasn't enough. It wasn't going to cut it. And so I started to get creative, looking for ways to get financial aid, looking for ways to get scholarships, and then ultimately built a company over a decade ago specializing in the college planning space and helping high-income families pay for college. And then when my income got into the $1 million range, I started looking for tax strategies myself. And those tax strategies led me to what they call the short-term rental loophole, or ways to use real estate to reduce your taxes. And then I thought, well, heck, this is exactly what my clients need. And so I started to teach my clients how to implement the same strategies that I was doing.
So what is that short-term rental loophole that you mentioned, and the real estate loophole? I know that's 2 separate questions. I guess it's 2 separate answers.
Well, so when you invest in real estate, it qualifies for depreciation. And so when you buy real estate, if you are a real estate investor, or if you are any sort of business owner, you can typically take advantage of that depreciation to offset your income if you have business income or if you have rental income. But if you have W-2 income, it's a little harder. If you have active income, you can't take a passive loss against an active income. And so an Airbnb fits under a completely different category. An Airbnb is under the hotel, kind of motel category, because they consider hotels to be active forms of real estate income. And so an Airbnb is ultimately an active form of real estate income. So it can offset your W-2 income. Now, the house has to be rented out for an average of 7 days or less throughout the year. It really does have to be what they call a short-term rental. It does have to qualify as a short-term rental. You can't just post it on Airbnb and have somebody rent it for months at a time. It truly does have to, have that turnover and that activity that a traditional, hotel would have. And then you can offset your income. So with bonus depreciation that they just brought back in Big Beautiful Bill, we can do what they call a cost segregation study that takes a normal depreciation schedule and just compresses that depreciation schedule for 1 year. You can take a big chunk of it in 1 year. So like last year, I bought a $1.5 million cabin that reduced my income by $450,000.
Skip,
I
what do
would
you
think that there's a big market in the Airbnb space to advertise this for benefit for people to buy Airbnbs to then use your services.
Yeah, so our services are, first of all, we go out and find the properties that would make a good Airbnb, because it's all about the right location, the right markets. And so we go out and find the properties. We do all of the underwriting and all the number crunching, all the pro formas and all the analysis of the property for the income projections and the tax savings, all that. We do all of that underwriting on the property. And then we manage the property. We market the property to promote the property and get it up to the top of Airbnb. And then we optimize the revenue, and then we sell it and go buy 2 more.
Okay, so that's what you do for you, but don't you also consult with people to help them figure out how to do that same or use that same strategy?
No, so we do that with them. So yes, we work with our clients and we partner with them on these projects and on these houses. And so we do a lot of the heavy work, a lot of the heavy lifting, and they are involved. They are involved enough to get the tax benefits. And so they have to put in 100 hours in a year. We have them get involved in building out the guest book and going out and staying at the place to go out to dinner and make recommendations on restaurants and things like that. So our clients are involved in the house or in the business to be able to qualify for the tax benefits, but we do a lot of the heavy lifting.
That's great.
Okay.
I think I have
And
a
let
few
me
family
just
offices we should probably talk to.
Yes, let's do it. Anyone that's a high W-2, high active income, 1099. I mean, even business owners love real estate, obviously. Everybody loves real estate. Most people just don't have the time, and they might not have the experience. And so we're just trying to make real estate as easy as possible.
And so let me just understand one thing. When you talked about short-term leases of less than 7 days, can someone rent the Airbnb 4 days on the weekend, over the weekend, and then every weekend have 4-day rentals?
Yeah, so you could rent it out for 2 weeks at a time, as long as you've got some 3-day weekends in there. It just has to average 7 days or less throughout the year.
It's contiguous.
Yeah. So just an average throughout the year.
Okay, that makes sense.
Yep.
Skip, what other questions you have for your family offices?
Well, I'm thinking back and saying, as a founder of this journey has had to change a lot over the time, and you've been able to expand it and grow it and go into these new areas. I was lucky enough to watch your interview from the original Shark on the Shark Tank. And it just seems like this is such a passion for you. And you already talked about what triggered the growth of it, but is the vision still growing? Is it expanding? How myopic are you on this at this point?
Yeah, so we helped families get creative with college funding for a lot of years, because high income families don't qualify for a lot of the traditional, financial aid, and then their kids might be exceptionally gifted kids, but they're going to top tier private schools where all the kids are exceptionally gifted, or you don't even get accepted. And so even though you might have an exceptionally gifted student, you go to these Ivy League schools and these top tier private schools, they don't offer a lot of scholarship money. So a high income family doesn't get financial aid, and a lot of times they don't get scholarship money. And so we've always had to think outside the box in helping families get creative with different ways to pay for college. We've used a lot of insurance products where they can kind of shelter or reposition some of those assets and sometimes qualify for financial aid. But then the income still disqualifies you. So even if you repositioned assets into life insurance, for example, you still have a high income, and that high income is going to disqualify you for financial aid. So by taking advantage of these tax strategies, you could wipe away your income. You could qualify for the federal Pell Grant. So if you showed no income, you could qualify for financial aid. But a lot of our clients are going to make over $1 million a year and still not qualify for financial aid, even if they take advantage of some of these tax benefits, because there's a $512,000 limit on your active W-2 income. So if I have a physician making $1.5 million in a W-2 job, I'm only going to be able to reduce about $512,000 of that. So they're still going to, they're not going to qualify for financial aid is what I'm trying to say. So we call these tax scholarships. If you reduce your taxes by $100,000, that's $100,000 that could pay for a year at a private school.
Sure.
So the
Now, are the schools, I would think that the schools would be very happy to introduce you.
Yeah, you would think. We're just trying to help families pay for those high price schools, but I'd also like those schools to just lower their prices. That would help all of us.
I went to Villanova. I don't think that's going to happen with the Pope now.
No.
So you mentioned the 512,000 of income. Is that really the number? So if I make 250, then I'm okay.
Yeah. So this year they changed it. I think it was 650,000 last year. This year they changed it to 512,000. So if your income comes from business income, you can reduce all of your business income. So if you're making $2 million a year in your business, then you can reduce that whole amount. But if you are a W-2 employee and not that there's a ton of W-2 employees making over $1 million a year, or over $500,000 a year. But if you're a W-2 employee, an engineer, physician, whatever, and you're making over $500,000 a year, that you can only reduce your W-2 income by about 512,000.
Okay. So the secret is really, if you're a high income earner, even if it's not W-2, you can still use this strategy.
Correct. But then also keep in mind that like when we partner with a client on this, or when we help the client do it, they don't have to partner with us. We can help them do it as well. But when they do this, they are now getting into the business world. And that's the other benefit of this, is that if you're a W-2 income earner, all the tax benefits go to business owners and they go to real estate investors. And so most W-2 income earners, they just don't have time to start a business or do a business. But when you get into the Airbnb business, you are now a business owner. So you are a real estate investor and a business owner all in one. And so now you can start taking advantage of all the other tax benefits. So the $512,000 limitation is for the bonus depreciation. So there's not a limit on regular business deductions. And so now you can start writing off your vehicles and putting your kids on payroll, and the Augusta rule. We just had the Masters. And so, there's the Augusta rule where you can lease your house out to your business. And there's all these different tax strategies that you can implement because now you're a business owner. So now any income that comes in is now business income. So as a business owner, you tap into a lot more tax benefits as well.
Lance, do you find that you have to really educate the client's accountant in some cases?
Yeah. I would say most accountants are tax preparers, and there's no offense to them. My dad was an accountant and my dad was a bookkeeper. A lot of CPAs, they'll help you prepare your taxes. They'll help you file your taxes. But I wouldn't say that most CPAs are tax mitigation specialists. I wouldn't say that a lot of CPAs specialize in mitigating taxes. They might tell you to max out your IRAs or something like that, but most of them are not going to be this strategic when it comes to reducing your taxes.
So in your example of a doctor with $1.5 million in earnings, what's the amount of Airbnbs that doctor would have to buy to max out the 512 in the first year?
So it's about 30%. When you do a cost segregation study, they're going to look at your personal property and all these things. So it's going to be about 30% of the purchase price. So if you buy $1 million, for easy math, if you buy $1 million Airbnb, it's going to reduce your income by $300,000.
Got it.
And so when you sit down with this doctor, how do you get paid?
So we get paid in a couple of ways. So we have a coaching program that also helps families fill out the financial aid forms and all that kind of stuff. So there's still that college angle so we charge a consulting fee to work with us and our team. They get access to our database of all these real estate deals. They get access to our team. They get a one-on-one specialist to walk them through the whole process. So lots of consulting and coaching is one way that we get paid. We also partner with our clients on these deals. So we'll go partner with the client on the deal, and we'll make money on the real estate deal along with them. And then we also get paid on some of these other tax mitigation strategies we teach in addition to real estate. And then ultimately, we are a financial services outfit. So we do help with all things related to financial services, and retirement planning is also part of our program.
Sure. You sound very active. Going back to how active they need to be in the Airbnb to take credit. You mentioned 100 days.
100,
Tell me more about.
Sorry, 100 hours. So
100.
yeah,
Okay.
so they call it the material participation rules. And so material participation basically means that you participate a minimum of 100 hours, and nobody else can spend more time than you. And so we have to make sure nobody on our team is working on that house, more than the client. And the client, I mean, if you're married filing jointly, the two of you, okay, a married couple could go to your Airbnb for a 3-day weekend, and you get to count travel time. You get to count the time you're there, the time you go out to eat, the time you go golfing to explore all the things for the guest book, and the time that you put into the guest book. All of those things count towards the 100 hours, and it counts double if you're married filing jointly. So it's really only 50 hours if you're doing it together.
Wow, that sounds so impressive. Well, Lance, thank you so much for being on our show. We really appreciate it, your content and your information, and it sounds like something we should all take advantage of if we're high earners. So thank you for that. Now, if you, next week's guest is Peter Antoine Esquire, and he's going to talk to us about immigration law. So we're obviously having a lot of issues with immigrants and also people still wanting to come to the country. And he's going to educate the audience on both what's changed, how do we mitigate risk, and how do we delve into the future to address those risks. Skip, thank you very much for being on the show with me. I think Lance was phenomenal. And really think that he added so much value to for our audience. So thank you, Lance, and thank you, Skip, for joining the show. Your money matters to us. Thank you for joining Money Matters TV. This is Tami Fratis from ACT Capital Advisors.